Hello and welcome to Money Matters TV. I'm Mike Dever, the founder and CEO of Brandywine Asset Management. And my co host today is Jeff Watkinson of Watkinson Capital Advisors. They're Muni Bond specialists. And our guest today is Eric Parnell, Chartered Financial Analyst and Chief Marketing Strategist from Great Valley Advisor Group. Hello, Jeff and Eric. Okay, so
Hey, Mike,
we're
how
going
are
to
you?
do things a little. Hey, great, doing great. Thanks. We're going to do things a little different today. Usually we'll just have a guest and we'll interview that guest and learn a little about their business. Today we're going to have a little bit more of a round robin format. I'm going to start with the question we have from a viewer, and then we'll kind of lead in, with that, answer that question, see where that takes us. But I think we've got a lot of knowledge here between, Jeff and the income markets and interest rate markets, and Eric, you've got such a broad breadth of knowledge in financial markets. It's going to be interesting half hour. So our viewer question, this is Glenn Roberts from Philadelphia, says the U.S. debt situation is worrying. Is this a problem? And what's the potential impact? And I want to just pull up a chart here to show what this is that Glenn is talking about. And this is a chart of the debt over the last now 20, 23, 24 years. And you can see it's grown pretty substantially from $5 trillion to today, actually now almost $33 trillion. And if you go back, to the 1980s, I remember people complaining about the debt and getting out of hand then, when it was even half of that level. Maybe even more concerning is the next chart here that shows debt to GDP. And you can see how as a percentage of the gross domestic product, it's actually at one of its highest levels ever. And the projections are it's going to continue to grow. And what's interesting, and this has grown substantially in the last 15 years now, from a third of GDP to 100% of GDP in a peacetime environment. The last time we hit these kind of numbers was during World War II. So, Eric, let's lead off here and tell me what you think. Is this a problem? And what's the potential impact of this debt growth?
No, thanks, Mike, and it's great to be on board with you and Jeff here today. So, it is worrying, and Mike, as you did such a good job of articulating, it's been worrying for a long time. I mean, I can remember when I first started teaching as a college professor back in the early 2000s, when the national debt was at $5 trillion to $7 trillion, and people were wringing their hands about it then. And I can remember back to the Reagan administration when people were concerned about the debt. So it is worrying. And the chart that you mentioned is particularly concerning in terms of debt as a percentage of GDP, because it all comes down to the question of it's worrying, but when does it start to become a problem? And as long as the market has shown the willingness to consume that debt, it's a supply and demand issue. As long as the market is willing to buy the debt of the U.S. government at a fair price, which 10-year Treasury yields at around 4.4% right now, the market's willing to buy that debt and has faith that the U.S. government's going to be able to service that debt. But we're bound to reach a threshold at some point, particularly given the outlook for entitlements in this country, like Medicare and Social Security, where the servicing of that debt will start to become cumbersome. And that whether that's 5 years from now, 10 years from now, that's a big risk. Is when do we reach that point, and then what do politicians do to address that issue?
Jeff, what are your thoughts there?
Yeah, I'd like to echo what Eric's saying. I'm obviously concerned about servicing the cost of that debt. Interest rates were at a generational low just 3 years ago, sub 1%, and now we're at 4.5%, 4.25% on a 10-year Treasury. That cost of debt every year becomes a higher and higher percentage of.
Jeff, we're losing you a little bit here. Okay. Yeah, I think I see the problem is one that where you'll go potentially for decades, where, as Eric, you're pointing out, people are willing to buy that debt. They're willing to get a reasonable interest rate. but it hits a tipping point, where what Jeff started pointing out, where the service on that debt reaches a point where people start questioning whether or not it can be sustained. And to me, it's one of those where it's either all in, it's working great, or it just hits a point and people say, you know what, this isn't happening. I have no longer have faith that this is going to be repaid. I don't know when that happens, if that happens, or if it keeps getting punted down the road or not. But that's my concern, is that you essentially have a weekend where, it turns, it's gone. I don't know. What do you think?
I think a good case to watch in that regard is what's taking place in Japan. You think about Japan, a developed economy, second largest economy in the world at one time, now the third largest economy. But they have demonstrated the ability, with a debt to GDP ratio that's significantly higher than that of the US, the ability to maintain market confidence in their ability to service their debt. If things start to deteriorate in some of these other countries that are even more leveraged than the United States, that could be an important warning sign of what might be coming eventually for the U.S. So just some things to watch.
Yeah, I'm thinking Japan aren't they a little different situation? I mean, it's a couple 100% of GDP, I believe, is their debt, but isn't most of it held locally? It's domestic. It's the Postal Service, has huge money invested in that. The other thing that I found always very interesting in the last decade about Japan is we end up experimenting, the world experimented with negative interest rates. You had $19 trillion at negative rates at one point. And in addition to that, they started buying back, not just doing short-term market activities, but buying back longer-term debt. And Japan took it a step farther. They bought back their stock market. The Japanese, Postal Service, the retirement guys they were the largest holders of stocks in the Nikkei. And I mean, it's crazy, where does it stop, right? But I thought that would have been the end of it, but it just seems like nobody cares.
Yeah, it's extraordinary to live in a world where we were at a point where investors were being paid to borrow money.
Yeah. And governments were buying up their stock market to help inflate, the economy. Yeah. Jeff, we got you back here. Looks like you're not fuzzy now. You were kind of fuzzing out.
Great. Thanks, guys. Yeah, I read a book recently. It's called The Accidental Superpower, and it talks about the United States, and it goes back in history. It's a history lesson of the ancient Egyptians and the Nile River and the use of waterways and leading up to the Erie Canal and how to transport apples across the New York State. And there's some really fascinating examples of the geography of the United States, which led it to become this accidental superpower. But you get into chapters 5 and 6, they start talking about demographics and the issues that Japan has had. I mean, most of their society is elderly. China has had that problem because they've had that one-child policy for so many years. And now with the United States, the baby boomers, but they don't think we're going to have that same problem with the demographics, especially with the immigration issue right now. But we're not going to have the same problems that China is having and Japan has had, I think is the point here.
Yeah, that's interesting because in the U.S., I mean, we do have immigration, maybe, it's always been a driver of growth in this country. The data on it shows that immigration increases economic growth. There's a trend to try to pretend that otherwise right now and to demonize immigrants when this country is built on immigration. I think you've got to have policies and can't have wide open borders. But it's not a bad thing. But then you get into something like Japan and China, where China right now, I mean, it's on a path to have half its population disappear by the end of this century. I mean, that is dramatic because they've got a huge shadow banking system, huge debt, they've been relied upon to be a driver of economic growth globally, and it's really tough to fight a declining demographic like that. I think to get back to that original question about debt. I think if you have a growing population and a growing economy, you can, and even though debt's been growing in relation to GDP, it still at least gives you a fighting chance of at some point keeping that manageable or paying down debt over time. I mean, people remember we had a surplus during Clinton's years. We were buying back debt, the U.S. government, not issuing it. China, I don't know how they do that, and that's definitely going to be a drag on the global economy. I would expect.
Yeah, it's so funny in terms of the economies that get so much attention. You think about Japan back in the late 80s and early 90s, and how that they were going to be the dominant economy for the 21st century, and that didn't pan out. And all the talk about China over the last 20, 25 years about how they're going to be the dominant economy for the 21st century. But one had to look no further than the actions that they took back in 1978 to know that at some point this was going to come apart. And that was it all comes down to demographics at the end of the day. And the points that Jeff, you and Mike raise are just spot on. It's not an exciting topic to talk about when it comes to investments or finance, but it all comes down to demographics. And, one of the things that differentiates China from Japan, China got rich before it got old, and it's been enabled them to sustain themselves. One of the challenges associated with China going forward, and it gets to the point that you raised, Mike, they got old before they got rich, and they have a tremendous amount of debt and a 4-2-1 problem of an aging population with the one-child policy they had for so many years. And that's likely to become an increasing weight on an economy that never really succeeded in getting fully prosperous before this problem was setting in. So thinking about population, what is the economy that's truly worth watching as we go through the remaining 75 years of the 21st century? You look at a country like India, a huge population, an educated population, a lot of potential, a lot of challenges there as well. But they're one that, has the ability to resolve some of those issues that China and Japan face.
Yeah, I think China right now, close to 20% of its housing stock is unoccupied.
Yeah.
You think about that, and now have declining population on top of that. At some point, half the housing stock will be unoccupied. I mean, you go into some of these towns in Pennsylvania, even in some of the old coal mine areas, and you can pick up houses for essentially nothing because they've been abandoned. And I could see the big areas, swaths of China, being that type of a situation where you just have abandoned cities because of the population leaving. The buildings remain. They need to start focusing on how they're going to manage that over the next 60, 70 years, not how they're going to manage growth. It's a totally different situation. India, I think, is making the right moves. They're certainly behind China on infrastructure. They're not quite ready yet to be the giant that China has been from an export standpoint, but China wasn't either 30 years ago. And India does have that potential. They do have still at least a stable demographic and a little better policy. I don't know for what reason Xi decided that he was going to take on capitalism in such an aggressive way, to start making it be difficult to be an entrepreneur in China, or impossible. It was appalling to me to see what he did with some of the tech companies. I didn't understand it. Now I do. It's how power people stay in power, and autocratic, governments and dictators stay in power. They get rid of anybody else that threatens them at all. But it's certainly been damaging to the population and the economy because of that.
Hey, Mike, can I jump in here?
Yeah.
I'm over here in my own little universe in municipal bond land, and I hear a lot about AI and the impact on not only companies and people's lives, but I'd really like to hear your guys' perspective on the impact of AI on the U.S. economy Is it going to be another growth? I'm trying to get my arms around this phenomenon that we've been experiencing for the last several years.
Eric, do you have some thoughts there?
Yeah. Yeah, it's one of the things that I always like to say is that when you have a bubble, that there's something transformational about that bubble. And that doesn't necessarily mean that you're going to realize the value immediately associated with that asset bubble. I think of the dot-com stocks back at the turn of the millennium. I mean, you had that bubble in dot-com stocks because there was a recognition of how transformational the internet was going to be for the global economy. Now, only a small handful of those companies that were part of the dot-com bubble 25 years ago are still around, but the transformational impact of the internet has been huge in that time since. I think we're seeing the same thing with artificial intelligence. The magnitude of the bubble is not as big. But the potential impact of artificial intelligence on the economy over the next 20, 25 years is likely to be meaningful in many ways and transformative in terms of the way we live our lives in many ways. Now, I don't think it's going to be a situation where artificial intelligence comes along and it puts all of these people out of work, because we've seen these types of changes going all the way back to the introduction of the computer or the printing press. It frees up people's time to be able to engage in more value-added activities. It makes us more efficient. It makes us more productive. And I see the same thing that's coming with AI. And where the opportunities are likely to lie with artificial intelligence, it's going to take time for that to make its way into the economy over the next 10 to 20 years, the same way that the internet has. And where the primary beneficiaries are from an investment standpoint, it's not necessarily those coming up with the AI technology, because it's going to be highly competitive in terms of providing semiconductors or providing, the systems in order to provide the artificial intelligence. Where the real opportunity exists to add value from a corporate perspective, who owns the data and who owns the access to the big data that can utilize that AI technology in order to get that competitive advantage.
Yeah, I definitely agree, Eric, that there's a lot of fear mongering that goes around with any new technology when it comes out, and AI is one of those. And you hear people talking about putting people out of jobs, and people just don't have faith in free enterprise in the capitalist economy. I mean, it finds a way to adjust. People will not end up massively unemployed because of AI. It'll create. And we've seen this over and over with technology innovations. It'll create more jobs than it's going to destroy. But it'll change things, obviously. Ultimately, you end up more efficient and better because of it. And you point out the dot-coms and the internet. I mean, it's just almost impossible to imagine when I started my business, the amount of effort it took for me to do a research project. Where today, I mean, it's in a matter of minutes, I have the data that it might have taken me weeks to accumulate 30 years ago. And that's all because of the internet and just that data is being so freely available. AI today, I use it, almost everything I write now, I'll run it through an AI, I'll call it a filter afterwards, just asking to clean it up or shorten it and just see if it comes back with better suggestions. I use it for my Excel programs that I write. There's a lot of things that are beneficial for me today with AI. 30 years ago, everybody had a secretary. You're dictating letters. I mean, that's all been cut out. You go direct to just typing it yourself now, or dictating it and letting it write it. It's made things so much more efficient, provided so many more opportunities for people to have better jobs.
Yeah, I've used it on LinkedIn. I've used it on ChatGPT.
Mm-hmm.
I find it fascinating. Those are two great answers. I mean, I think the biggest takeaway is we're not even sure how we're going to use it yet in the future, like the internet. I mean, you think of Uber, cell phones, internet. It wasn't until we had the smartphone that we could create Uber. And that's just one example of, I guess, using that technology going forward. I'm curious what your clients are asking you. Like, what are the hot topics, or you have any repetitive questions? Noticed any patterns in client questions about, I don't know, stocks, crypto, the economy, because I'm just interested.
That's really you, Eric. I mean, we're a fund manager. You know, we run funds and kind of do our thing, and so we don't really have clients asking us things like that. But I'm sure you get, and your firm's getting
Yeah.
that all the time.
You get a lot of questions around, what's the best way to position for artificial intelligence in the current marketplace? And the first thing that I'll say, it's important to be careful. I can remember 24 years ago, the shares of Cisco Systems, trading at 100 times earnings because Cisco Systems was providing all of the tools for the on-ramp for the internet. And it was only just recently that Cisco surpassed the previous all-time high in a dividend-adjusted basis that it first set in 2000, in the last year or two. That's a over 2-decade wait to get back to that point. There's other companies that are out there today, like NVIDIA is a perfect example. Yes, they're providing the semiconductors that are enabling all of these companies in order to incorporate this artificial intelligence technology. But they're also trading at about 28 times sales, not to mention about 80 times earnings. So a lot of that optimism is priced into the stock, and they've done a phenomenal job in terms of exceeding those expectations recently, but it's the bar is set very high, and they're not alone. I mean, there's a number of companies that are kind of the poster stocks for artificial intelligence and their potential. We still want to be sensitive to valuation and the price that we're paying for that potential future growth, because really a true exposure to artificial intelligence, and this gets back to, who are going to be the true beneficiaries from a corporate earnings and a corporate opportunity standpoint going forward. It's going to be those companies, and this gets back to Jeff's great point. We're still discovering how artificial intelligence is going to be effectively utilized. Those companies that figure out how to get competitive advantage associated with the utilization of artificial intelligence. I'll put an example out there. Think about really boring companies, grocery stores. What do you do every time you go to the grocery store? You swipe that card, you put in your PIN number, and you're giving the grocery store all of the information around everything that you just purchased on your shopping trip. And every time you go into that grocery store, you're giving the grocery store a treasure trove of data about your shopping trip, as well as everybody else that's in the grocery store lines with you. So the potential for artificial intelligence, companies like grocery stores that have accumulated just troves of data that can utilize artificial intelligence in order to figure out ways to optimize their business operations through the use of artificial intelligence. The potential there is huge. So the real opportunities in artificial intelligence over the last 20 years, it may come from places that people might not expect.
Yeah. So what do you see, the both of you, for investment opportunities for people that should they be putting money in artificial intelligence stocks? Is NVIDIA a buy, or is it like Cisco 25 years ago? Jeff, I mean, your Muni Bond market, are there opportunities there that are based on some of these things we're talking about, demographic shifts or inflation or things that are of value that you see?
I'll tell you where we're finding a lot of value right now, and this is a great story. And the question I throw at investors is, what if I could show you a bond, AAA rated, yielding close to 5%, virtually riskless? Would you be interested, earning 50% or more yield, 15-year bond? Would you be interested in hearing more? And the other caveat is, and you want to help solve the affordable housing crisis in this country. There is an affordable housing crisis in this country. And the first quarter of 2024, we've seen a ton of deals, new money coming from state and local housing authorities. And we've been in these deals, and these deals have been priced to sell super cheap, big yields. And there's a little story attached to them. And it's a great strategy that we've been doing this year. And I just read in Bloomberg last week of March of 2024, that's about close to $9 billion worth of new housing deals in the market, the most in over a decade. So whether it's Delaware, Pennsylvania, South Dakota, North Carolina, Illinois, we've been in these deals. So let me tell you a quick story. The state of Illinois, just that name alone drives a lot of people away from the municipal bond because it is the fiscal poster boy of irresponsibility. I mean, they're a bunch of crooks. But this bond, it's a single family housing it's from the Housing Authority. It's a single family housing deal. We like single family housing over multifamily housing. And this bond is AAA rated by Moody's, and it's backed by Fannie, Freddie, and Ginnie. It's virtually riskless. And what's cool about this, Eric, and what's cool about this, Mike, is the structure of these deals have been similar in these 4 or 5 deals that we liked. And the bankers, what they do is when they structure these deals, you get into the official statement, there's a bond, there's a tranche called the PAC bond, PAC, planned amortization class, which is the furthest maturity out. And do you know anyone who is still on their original 30-year mortgage from their first house?
Right. Well, with rates coming down like they did, everybody refinanced in the last decade.
Exactly. Yeah. People refinance, they have more kids, they move jobs, life happens. What happens to the proceeds when that mortgage rolls over? It goes to that PAC bond. That gets paid off first. The bankers structure it with the actuaries to have a 5-year average life. So that bond's going to go away in 10 years.
Mm-hmm.
We like buying the bond right underneath that PAC bond. So, for example, we bought Illinois, a 475 coupon at par, yielding a 475. That's 50% more yield than what the scale will pay you. That's how cheap the deal was. Virtually riskless. And it's going to be a 15-year bond because once that PAC bond is satisfied with prepayments, they're going to start calling the 2049 bond.
You would be looking at these then over top of going into a treasury, a 10-year treasury or 20-year or something like that?
This is part of our strategy to lengthen duration and to provide extraordinary more yield to our client.
Okay, and just to wrap up that because we have to go here, but the interest rates that we've seen spike up provided this opportunity, and you're not worried about the debt crash or something that's going to maybe even spike rates higher and make these things, perform poorly. You think they're in a solid position?
I can't predict interest rates.
Yeah.
My opinion on interest rates is as useful as a used Kleenex.
All right.
We're looking at value in the municipal bond market, and
okay. Well, I appreciate that, Jeff.
Okay, Mike.
Thank you. Yeah, and I'm sorry to cut. We got to run here. And Eric, again, thank you very much. Our next guest on Money Matters TV is Alexander Schultz, founder of Dream Capital Financial Group. Thank you for watching Money Matters, where your money matters. See you next time.